And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Group and DHL Go Trade. African SMEs are now closer to global markets. Good evening, 9 minutes after 6. Welcome to the program. I'm Stephen Grootes. We'll speak to the Absa CEO, Fihla, in just a moment. Very, very strong results from them. In fact, record-breaking results in some respects. So looking forward to that conversation. I think lots to ask around Absa, as you can understand. Chris Yelland will be on your radio in a few moments as well. Finally getting more details from the electricity minister about how the new electricity pricing system is going to work, the new tariff system. We don't have the full details yet, but we got a deeper understanding from some of the public comments made by the minister today. And as you know, the whole point is to try and make the price that you pay for electricity cheaper, to try and make it cheaper for you. I know it's having a big impact on your life. And Bernstein at the Center for Development and Enterprise, she'll be on your radio in around half an hour talking about Joburg, why fixing it needs to be a national priority. I think there's going to be a lot of commentary on Joburg. And I did sort of think about a year ago, the focus of the local election will be Joburg for various reasons, its size, the problems it faces, all sorts of reasons. I think also the DA's choice of candidate, the way the ANC hasn't yet announced a candidate, I think that's part of the story as well. Talking of Joburg, an important story in Ground Up this week, and we'll actually speak to the journalist there, Seth Thorne, that Joburg's Master's Office still having big problems. And you know, when we try and speak to attorneys or get people to come and comment on this, people don't really, they're a bit nervous, they're a bit sort of not scared, but just think they might not get the service they need. If you've had an experience at the Joburg Master's Office, please, won't you let me know about it? One of those few times we'll let you stay anonymous if you prefer. I mean, if you don't have to, then don't. But 072-702-1702. Have you been there? I understand it's just full of paper. You know, it's a bit like going to the Road Accident Fund. But your experience of the Joburg Master's Office, please, on 072-702-1702. I'd really appreciate that. 11 minutes after 6.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, Absa reporting today its headline earnings up by 8%, dividend up by 8% as well. This is for the 6 months to the end of June. South African operations seem to be flying. Their earnings up 17%. Operations across Africa, though, seeing their earnings drop by 10%. Well, the group CEO at Absa is Fihla. Kenny, good evening. Welcome back to the Money Show. I really appreciate the time. Your personal and private banking division increased their headline earnings by 12%. It's a big jump, had a big impact on you. What do you think is working for you there at the moment?
Well, good evening, Stephen. I think there are a number of things that are happening in that business. Firstly, there's a growth in customer numbers, both in South Africa as well as in Africa regions. I think secondly, the region has improved on its risk quality. One of the undermining factors in the past has been the credit impairments. That seems to have stabilized as within the quality and start to focus on clients whom we've got a primary relationship with. The third factor is the rate of converting clients from manual processes into digital channel, which are far more efficient, easier to cross-sell to the client base, and I think the momentum is there. Clearly, there's a lot that we need to do, but we're pleased with the momentum within our personal and private banking business.
Your corporate and investment banking division, I mean, that was up just 1%. Is there a problem there? Is it just a general economic story?
I think it's largely two factors. The South African business did exceptionally well, was 13% up, which is pleasing, at the back of a stronger deal origination. Unfortunately, in the Africa regions, there are two factors that affected that business, which was 12% down, resulting, therefore, overall in the CIB business being only 1% up. The first is the interest rate reductions in Ghana and Kenya. Our business has a huge deposit base in the corporate and institutional space. With massive reduction in interest rate, it loses on the interest income at the back of lazy deposits. The second factor is the less volatility that has been experienced in the first half of the year, largely because of the onset of the Middle East sort of war, which has resulted in clients being far more risk averse and not really wanting to sort of manage and hedge their sort of positions. We are confident, though, that the trend is starting to pick up. However, the interest rate headwinds will remain with us for the remainder of the year. But we have a solid base upon which we can build in 2027.
Your operating expenses, they were up 5%, and you say that's because of continued investment in digital capabilities, as you talk about. I know that obviously AI is going to play a big role in banking in all sorts of ways. Your competitors are talking about this. Are you comfortable that Absa is keeping up with other banks in this? I think there must be a lot of investment in AI and digital technology right now.
Yeah, our sort of costs were up 4%. Largely driven by two factors. Natural inflation increases on our staff base, but the other operating expenses were only up 3%. We also had to invest in strengthening our capability, both in terms of just strengthening the leadership band strength, but secondly, investing in data, AI, and accelerating the pace of digitalization. I am comfortable that the level of investment and the progress that we are making is on par and in some instances slightly ahead of our competitors. But we need to make sure that we spend on the right things and that ultimately those things result in meaningful client experience and can unlock our ability to roll out new solutions to our client base.
In your documents, you refer to the sort of higher levels of fraud in South Africa, and that's one of the reasons that your operating expenses increased a little. I mean, it's such a big problem for everyone. Do you see more intense efforts by people to try and steal, from you and your customers? You have to spend a lot more money guarding against that now?
Absolutely. I think fraud overall has increased quite significantly in the last couple of years. And we're seeing criminals also adapt to AI and becoming far more sophisticated than they used to be in the past. And unfortunately, they target vulnerable segments of our client base, and we had to step up security. We had to continue to make it difficult for them to break into clients' accounts, for them to access client PINs as well as ID logins. But at the same time, we are also sympathetic to clients, especially the vulnerable sections of our client base, older sort of people, where we reimburse them even if the fault was not really on the part of the bank, because we understand the difficult circumstances that they are confronted with, whilst tightening education and ensuring that we can continue to implement new measures to make it difficult for them to be defrauded. I think this is an industry-wide problem, but we have seen some sort of a reduction in the number of fraud cases in the last 2 months or so, and we'll continue to enhance and put new measures to make sure that we can reduce that to the absolute minimum without putting too much pain on the clients, because the more we tighten, the more we put new measures, the more difficult it is for clients to transact easily.
You spoke about strengthening the leadership band. You have quite a lot of newish talent in some of your leadership positions. How long do you think it's going to take before they're all firing on all cylinders, before you start to see real changes? I'm sure you see some already. Some it will depend on when people were appointed. But are you expecting to see real changes quite soon?
The expectation is that we will start to see some green shoots coming through the business. And I think there are early signs that things are moving in the right direction. I think the big issue that ought to be attended to is to accelerate the shift in the culture of the organization. We have excellent people, amazing clients, great solutions, but unfortunately, some of the repeated leadership changes of the past have resulted in the culture within the organization being too internally focused. So we're shifting that to be customer focused, to be outcome based, as well as to be driven by a sense of confidence and characterized by excellence. There are early indications that our turnaround times are reducing. We're getting feedback from the clients that there's far more greater interaction and solutions being presented to them by the Absa team. We just have to continue to do the right thing continuously on an ongoing basis over a long period of time for us to be comfortable that the culture shift is now truly embedded. Clearly, in an organization that has 36,000 people, you can't turn the culture around around overnight, but I think the direction of travel is positive. 2027, I think, will be a telling year. This is a transition year. Whilst we still need to maintain delivery on the financial performance, I think 2027 will be a year where we'll be expecting a step up, given that the new leaders would have settled for quite some time.
Kenny Fihla, I really appreciate the time. Thank you very much indeed. The Group CEO at Absa, 19 after 6.
702.
702.
Stephen is on The Money Show.
6 to 8 p.m.
The Electricity Minister, Kgosientsho Ramokgopa, releasing more details today about the draft new electricity pricing policy. He believes it will eventually make the price you pay for electricity a lot cheaper. Chris Yelland is the energy expert, managing director at EE Business Intelligence. Chris, good evening. So the policy is supposed to make your bill a lot more transparent, easier to understand. It has to be cost reflective. It has to protect poorer people. It has to encourage industry, and it has to manage cross subsidies properly. Is that a lot to ask of simply a change in a tariff mechanism?
Look, Stephen, everything you've mentioned, has been in the same policy document previously. There's nothing new in what you've said. Those are all aspirations that were in the existing electricity price policy. So in listening to media briefing today, and it was very disjointed because it wasn't effectively broadcast on YouTube and Facebook, the normal GCIS channels. And we only could watch partially on the SABC, TV channel. But from what I heard, and there's still a lot to come because we haven't seen the official document, which is only going to be gazetted on Friday. But from what I heard, I didn't see a lot new. A lot of what we see is just the same old stuff. Cost-reflective prices, the cost recovery mechanism, the need for efficiency, the threshold on non-technical losses above which cannot be recovered in the tariff. All of these things are standard stuff that has been there all along. And what I took away from this, and it's left a lot of unanswered questions, is how is all of this going to be implemented? In other words, we're seeing, from what I saw from the PowerPoint presentation, there's a lot of aspirational policy messaging, which is fine. It is a policy document. But the real question is, how is that going to be translated on the ground, and how will this affect the prices that we pay? And that is not clear at all.
So, I mean, the price it costs to produce electricity and get it to my house, that cost surely, you can't get around that with a new formula. The cost of that is the cost of that. Exactly.
And what they talked about, for example, is this increased transparency and unbundling of the tariff. Nothing new in that. That is what they've been doing. That's what we have unbundled tariffs at the moment. And so, yes, I think there is room for further unbundling and clarity in municipal tariffs. But Eskom tariffs are pretty much unbundled, and we can see where they, how it's made up. But that doesn't change the price we pay. That just separates the price into different components. I fail to see exactly what is new in this. There's a little bit of something new, but it raises more questions than answers around the free basic electricity and how this is going to be funded. Because the minister talks about increasing the number of people who receive free basic electricity by a factor of 5. Because at the moment, only 20% of qualifying households, receive their free basic electricity allocation. And he wants this all to be done, and he's got some mechanisms with databases, etc., that would extend this to all qualifying people. That will mean 5 times more people get free basic electricity, and there is money for that. That's what National Treasury has put aside for. But at the same time, he wants to increase the free basic electricity allocation from 50 kilowatt hours to 250 kilowatt hours. That's another 5 times increase. And that means that the free basic allocation from Treasury needs to be increased 5 times higher. And it's not going to come from National Treasury. Where is it going to come from? Presumably from the customers that pay for electricity will all have to pay for the free basic electricity. So it's not going to be a separated, a funding mechanism that is transparent. It will be built into the price of electricity. So I've got more questions than answers, to be honest, at this stage, but I'm on Friday.
Chris Yelland, thanks very much indeed. The energy expert, managing director at EE Business Intelligence. Well, Friday is when this will all be gazetted in the government gazette. The minister has been talking up the changes, but it does boil down, I suppose, to the same question. The cost of making the stuff and getting it to you is the cost of making the stuff and getting it to you. How will that change? It might not. 24 minutes after 6.
The Money Show.
The markets.
Kwena Maloko is in equity research, sales and investment banking at Absa CIB. Kwena, good evening. Well, Absa doing very nicely, very strong results.
That's right, Stephen. Good evening. So yeah, Absa came out with its interim results today. I was there a few weeks ago just after their pre-close update. And I think the important point is that there weren't really any big surprises in the numbers, right? So we already knew that the South African business was performing better than the rest of Africa operations. And that's exactly what we saw. Headline earnings was up 8%. ROE was marginally better at 15%. But I think the story for Absa now becomes much more forward-looking from here, right? So we've seen some really high-profile hires. We've seen a change in strategy. And I think investors now want to see that translate into the financials. So all the questions are very much forward-looking from here.
And I mean, people will want to see, you would have heard Kenny Fihla talking about the change in culture. It's a hard thing to do for such a big institution.
Exactly, Stephen. And that happens sort of one person at a time. But given what Kenny said, he said he's already seeing it even through the way customers engage with the group. I think they're starting to make some significant inroads.
Strong results today for BHP as well. High copper prices having a big impact on them.
Yes, and that was interesting because at first glance it looked like the net income number was a little bit of a miss, but a lot of that was related to the impairment of Jensen, the potash project in Canada. But like you rightly point out, right, copper now for BHP is the biggest earnings contributor at about $18.2 billion. It's about 55% of group EBITDA. And why that's important is because copper is one of those metals of the future, right? Commodity. The demand side of things is actually quite clear and solid. You've got electrification, EVs, power grids, AI and data centers build-outs. And all of those require a lot of electricity and a lot of copper. And at the same time, in copper, what you're seeing is mine supply keeps struggling to meet expectations. So the market is quite tight. The prices are quite good. And that's why you're able to see that results are good and they can surprise on the dividend as well. That was 10% ahead. And investors always like it when miners return money to them. So I think importantly, though, from this point onwards is because we can see the prices, because the earnings are starting to benefit, investors are going to keep continuing expecting BHP to continue to deliver. And more importantly, though, they're less of an iron ore play and much more of a copper play, which puts them on the radar of a lot more people.
And then higher oil prices, and I think the idea really beginning to sink in that we're going to have oil at $90 a barrel for longer, leading to a big spike in US 30-year bond yields. The highest since, I suppose, the start of the global financial crisis.
Exactly, right? 5.3% on the 30-year Treasury is the highest that we saw in, I think, June 2007. Importantly, the 10-year as well, that's sitting at 4.7%. So it's a fairly significant sell-off at the long end of sort of the longer-dated bonds. And I think a few things are happening all at the same time. Like you point out, whenever oil's around these levels, $90, $100 a barrel, we start talking about inflation. And obviously, investors then demand a higher compensation for owning bonds that have a little bit longer duration. But secondly, there's always this question of U.S. fiscal risk, right? The government needs to issue a lot of debt, and there's a lot of treasury supply that needs to be absorbed. But when we were talking a few weeks ago, we started talking about AI, right? And how these hyperscalers, Google, Meta, Microsoft, are spending enormous amounts of money building out data centers and AI infrastructure, and they're increasingly using the bond market to do that. So suddenly it's not just the government that's supplying bonds. As a bond investor, you have the choice to take on the government debt, or you can take on debt from some of the world's biggest and strongest companies and pick up additional yield. So of course, this is starting to put a lot more pressure on the long-term yield, and that's important for us equity guys as well, because those are the yields we use to sort of price our stocks. So this weakness you see in the S&P, particularly in the Nasdaq, I think you'll continue to see that wash through at least the Asian session tomorrow and our market, because these tech names are so big. They're probably one of the biggest factors in terms of global risk on and risk off sentiment.
Kwena Maloko, thanks so much. Really do appreciate it. Equity Research, Sales and Investment Banking at Absa CIB. By the way, please, the Joburg Masters Office, the problems there, if that had an impact on you, would be good to hear from you on 072-702-1702. Just gone 6:30.
WhatsApp Stephen
On 072
702
1702.
23 minutes now to 7 the time. Well, I'm still puzzling a little bit over the new electricity tariff system, and I'm kind of hoping there's something in the final version that will explain some of the issues. And, I know how important this issue is to you and the impact it has. I know people who tell me they don't use electricity, or they can use it for certain things, but they still spend a lot of their time in darkness just because it's so expensive. It's one of the big issues of the moment. So, the point that a new pricing formula can't really make a big difference, I think must be true. What will make a big difference, and people have spoken about this, is proper competition. And we're seeing that in all sorts of ways. And I mean, the moment might come when there's a solar provider near you, or someone, or informally, or whatever, that's able to provide you cheaper electricity, or at least compete with Eskom in some way. So, I mean, those kinds of flexibility options are going to be very interesting to watch. But we'll await for Friday on that. Still keen to hear your story about the Joburg Masters Office. We'll talk about that in a few moments as well. 22 minutes now to 7.
The Money Show with Stephen Grootes is brought to you by Absa Group and DHL Go Trade. African SMEs are now closer to global markets.
18 minutes now to 7 the time. Well, the launch today of a new series of reports on the situation in Joburg. It's by the Centre for Development and Enterprise, and detailing some of the problems facing the city. Obviously, local elections coming up, and I suppose asking one of the fundamental questions about this local election, if you think about it, which is, if Joburg can't be fixed, if the economy around Joburg can't be fixed, can you really fix the economy of the country? We've seen a real change where some of the economic gravity is moving to the Western Cape, and you can't really get around that. So the numbers do point in that direction. Lots of very contested reasons as a result. And Bernstein's the Executive Director at the Centre for Development and Enterprise. And good evening. Thanks so much for your time. So I think people who live in Joburg know how deep the problems are, how entrenched some of them have become. You can see it all around you. It's inescapable. How big an impact do you think, or what impact do you think this is having on the national economy? It must be weighing quite heavily.
Well, good evening, Stephen. Thank you for the time. Our argument is not so much, let me put it this way. The impact Johannesburg's precipitous decline is having is not something we can quantify for you. But if you look at what Johannesburg is economically, you can appreciate how its lack of growth, its stagnation, what impact that is having. So, for example, this city is still the center of our sort of corporate South Africa. 70% of corporate headquarters are in Johannesburg. We're the place where the most personal income tax is raised, nearly 22% in the country. And it's the commercial, financial, and retail hub of South Africa. So imagine if this is not growing, and in fact is kind of heading in the wrong direction. This has a big impact on the economy. But the other point we're making is that countries need successful cities. They need growing, thriving cities, especially when they're an urbanizing country like South Africa. And if Johannesburg is not playing its role as a center of growth and jobs and opportunity, it doesn't only affect the people who live here terribly, all of us, but it affects all those people in the rest of the country who historically would have moved to Johannesburg more than any other city and found opportunity and ways of improving their lives. So that's being delayed, halted. So this is quite a complex set of relationships that Johannesburg's decline has, not just for the people who live here, who suffer from property prices not going up, or if you're poorer, not having sort of ladders of opportunity in the city, which is what urban areas are all about.
We'll talk about all of the infrastructure issues in a moment, but is it, for you, it is primarily a political problem?
Absolutely. I mean, if you think of the situation here, we've had 9 different mayors in the last 10 years. We've had 8 different administrations, and no mayor has completed a full term. What happens then is that we don't have stable long-term planning, and every time there's a new political administration or political shuffle, we get new appointments, new priorities, and policies shift with the political winds. You can't run a city like that. So what we need is the local government elections have to deliver a stable, really competent, bold leadership that is going to be able to introduce the reforms and changes we need and have a full term on which to deliver them. So November 4 is very important. The local government elections, it's a chance to turn this terrible situation around.
The other problem is, okay, if it is a political problem and that's resolved, or if somehow there's a change in direction, is the sheer amount of money that will be needed. I mean, I think the electricity infrastructure, we're looking at 44 billion rand alone. I don't even want to think about water and electricity together, never mind the roads. I hate to put it bluntly, but I'm not sure that even Joburg, or even with all the best will in the world from the rest of the country, we can find that money very easily.
Look, that's a very important question. Turning Johannesburg around is not going to be easy at all. Next week, in our second report, we are going to talk about the Johannesburg budget, and progressively, as we release reports almost every week, we're going to start answering some of those questions. So what we're saying is, first step, you've got to get a stable and highly competent new political administration for the city, leadership and administration. But then they have to look beyond the political party for the kind of excellence that Johannesburg is going to need, the best possible people to think about how to run city power, or the best possible people to sort out Johannesburg water. So they're not going to be there, and they have to have, the new government's going to have priorities. They're going to have to recognize they can't turn the city around on their own. And we are thinking very hard about the implications of all of that, and we'll go into it as the series develops. Money is critically important. Wait for next week. We're going to explain where the money is going, and what I think a lot of what can be fixed. But you're absolutely right, with the kind of debts Johannesburg has, we can't see, we're going to have to be very innovative in how we move forward. We're going to need the best financial architects in the private sector, and we're going to have to talk to the national government as well.
So the other thing that it will need is time. And I mean, obviously, you know, lots of people moving in one direction with a lot of capital can get things done actually more quickly than you would think. But probably a decade. At the same time, though, you change a few things, you improve a few things. It makes the next improvements easier, doesn't it?
You've got to turn the momentum around. At the moment, we're heading downward in terrible direction. You're going to need real political skills to prioritize and communicate very effectively with the citizens to say, we can't fix everything at once. And this is why we're doing 1, 2, and 3. And this is how it's going to start affecting your life. So I think that's going to require real political skills. Johannesburg has an enormous number of highly committed citizens and organizations that are one of our great strengths, and I think the new political leadership is going to need to call on them to help it communicate as well as selecting priorities. And I think once you start getting a different momentum, you can get people's patience to fix this, because you can't do it all overnight. And you can do a lot of things if that start changing not everybody's lives, but some people's lives, and then the word spreads that, oh, this pipe was fixed here, and this substation has been fixed and it hasn't broken for the last 6 months. So people talk to each other, and that I think people are very realistic about the challenges. So skilled political leadership, getting really excellent people to start the ball moving. And I think Johannesburgers will appreciate the momentum is going in a different direction. But it's not going to be easy.
Anne Bernstein, thank you. Executive Director at the Centre for Development and Enterprise. Well, lots of things to think about with the city of Joburg. Your thoughts, please, on 072 702 1702.
702. Stephen is on the Money Show.
6 to 8 p.m.
7 minutes now to 6 the time. 7 minutes to 7 the time, I should say. Well, more reporting this week about the problems at the Master's Office in Johannesburg. It's the office that deals with estates and trusts and insolvencies. Lawyers telling the reporting organisation Ground Up that it can be almost impossible to get the correct documents. And I must tell you, in the past, when we've tried to get lawyers to talk about this, very difficult to do for lots of reasons. People are a bit worried about how they might be treated as a result, and I can understand why, but it does make it difficult for us to get an understanding of what's going on. Seth Thorne is a journalist at Ground Up. Seth, good evening, and thanks for talking to us tonight. You heard the complaints, you heard about issues, you went to the Master's Office. What did you find?
Hi, Stephen. So Ground Up has long reported on issues at the Master's Office, and there have long been promises of improvement. So we went to go follow up to see if there's been substantial progress from when we last reported. But from, like last time, a pattern emerges of overwhelming complaints about backlogs, delays in receiving documents, alleged corruption, and a big problem is also systems being offline. So just from speaking with lawyers, they have spoke a lot about the inefficiencies, and some of them described the whole process as almost soul-destroying, because they're dealing with people at very vulnerable points in their life, and matters that shouldn't be taking more than, a couple weeks to a couple months are dragging on for years because of, all these inefficiencies.
Isn't a lot of this supposed to be digitized? We are, last time I checked, in the year 2026.
So, interestingly, in the past week, the Minister of Justice and Constitutional Development, Minister Kubai, has referred the whole digitization process to the SIU and Hawks, because she went on an oversight visit to one of the Master's offices, and she was inundated with complaints about the service provider allegedly withholding documents. So that was the reason given for various documents being online. So the whole digitization project was initiated 5 years ago to try deal with these increasing records volumes. I mean, in these offices, there are just mountains of paperwork that consume you, limited internal storage capacity, inefficient record retrieval processes because things would just get lost. But the statement said that instead of making it more efficient and faster to render services, the digitization project itself is now at the center of service disruption and service delay.
I mean, excuse the cynicism, Seth, and I won't ask you to make a comment on this, but a paper system is much easier to let corruption in the system than a digital system. I mean, it just is the way it is. So when you go there, and, you've got piles of paper all over the place. And in my experience of government offices, when this happens, almost automatically someone seems to come and offer to help. Is that happening here?
So what you the first thing that you see when you enter the office are signs plastered everywhere that, in capital letters, that services here are free. Do not pay for any services at the master's office. But person after person after person that we spoke to alleged that the more desperate you may seem while you're in the office, the more likely you are to be approached by someone who says, well, what can you do for me so I can help you here? And it's almost like an open secret in the office where, a bribe of, let's say, 1,000 rand could allegedly get your paperwork fast-tracked incredibly, within a couple of days, whereas some people are left waiting months to over, even more. So the people we spoke to say it is an open secret, and while the department has said there's been many interventions and they have a zero-tolerance approach to corruption, it seems that it's systemic and it's deep-rooted and it's tough to root out.
What impact is this having on people? I mean, they need these documents. Sometimes they need them quite urgently, if just to close off certain things. Often an estate, someone has passed, it's very difficult. They're supposed to get them within, a week, 10 days? I mean, these things drag on in all sorts of horrible ways otherwise.
It is for people, the legal professionals were saying, even they battling, and they can't imagine what people who are unable to afford the luxury of legal services. So these delays in, for example, appointing executors can prevent beneficiaries from accessing money and insurance benefits for quite some time, all in the process of, they're grieving and mourning. So it's when they're at their most vulnerable state. And delays in insolvency matters, for example, can affect creditors, workers, and business operations.
Sure. And no sense from the Justice Department when this might get better?
The Justice Department, they are waiting on now the investigation. The referral to the SIU and Hawks hasn't kicked off yet. They said they will continue with the updates, but it is just this week where they've referred this. They referred the digitization project. But, we've been hearing for years and years that there are going to be tangible improvements. And as our follow-ups have been showing from our reporting, that improvement hasn't been felt on the ground yet.
Seth Thorne, thank you so much. I really do appreciate it. A journalist at Ground Up. As I say, some of government offices, it really shouldn't be hard to do this. And there's been a big digitization project at Home Affairs, for example, to digitize all the records that go back hundreds of years in some cases. And people got their first job literally managing the digitization process, taking the old documents, taking a photograph of them, I suppose, if they're very old, putting them in some kind of copier machine to digitize them, to scan them if they're a bit newer. And yes, it would take a while. AI will do half of it for you because it recognizes the text and is able to do things that were unimaginable 5 years ago. So I think there's so much to this, but I think really, it should be done better, and you deserve better from the Master's office if it's happened to you, frankly. I think if I were in the Justice Department, I would think to myself, well, we must be better than this. We must actually do something about it. So I think it's a really important story. You're at The Money Show at 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Group and DHL Go Trade. African SMEs are now closer to global markets. 7 minutes after 7. Every now and then you'll hear a bit of an argument or a discussion about environmental authorizations. You have a new installation as a company, whatever it is, from, a new, I suppose, shed or something to all the way up to a power station or just as an expansion. You have to apply in certain cases for environmental authorization. You go to the Environment Department, I presume. Well, we'll talk a little bit about that in a moment. I think there's some very interesting numbers that are showing you how they're approved. And on the one side, it seems that the approval rate's incredibly high. And there are two ways you could look at that. And I'll put it to Tony Carney in a moment. But on the one side, you could say, well, the department is approving too many. You could also say, well, they're doing the right thing because they're approving well-documented applications. And I would presume, I've never done it, but if you had to apply for one of these things, you would get a sort of professional to help you. You would comply with the law, and therefore your chances of getting the approval would be very high. So I think there are a couple of ways of looking at that. We'll hear from Professor Utindo Ndingwi, who will update us on what's happening in our continent. And then Warren Ingram this evening. Such an important question, how to draw an income from your investments without running out of money. And I don't just mean that you live on bread and peanut butter for the rest of your life. I really do mean, how do you actually live on a small amount of money without touching the main part of your investment? It can be very, very difficult to do. Good to hear from you. 011-883-0702, 021446, and of course voice notes on 072-702-1702.
WhatsApp Stephen
On 072
702
1702.
Well, Robert has messaged saying, "Hi, Stephen. My mom passed away 10 years ago. This is about the Master's Office. My family immigrated from Zimbabwe in 1978. The Master's Office lost the file several times. It had to be resubmitted. They then wanted an electronic version of her permanent residence certificate from 1979. And then 6 months ago, they wanted the accident report in case there was foul play. Countless affidavits followed. The firm of attorneys appointed as executives kept hitting a brick wall." Robert saying it's a hot mess. Does sound like it. Does sound very difficult. Sure, Robert. Yeah, I mean, look, I sometimes think that, you have to be careful. I can understand why someone would want to be careful. But sometimes you can just look at a case and you know what happened here and you need to just approve it and move on. That's certainly the way I would see it. 10 minutes now after 7.
Hi, good evening. Just a quick question from my side. As you've mentioned the numbers, around 40 billion just to fix the electricity or the roads or water. It doesn't matter when it comes to 150 billion or 180 billion rand to fix everything. My question is, where is all these infrastructure loans that we make against the World Bank, the IMF, all of those international instruments that we borrow from? I think now a week or two ago we also borrowed converted in South African rand a couple of billions of rands. So the money, there's been loans made on behalf of our government are making these loans, and it says it's to fix infrastructure. So it's not that we have to come up with this money. The loans are being made, the loans are being granted. Where is that money going to?
Yeah, no, it's like the Joburg budget. It's 85, 89 billion rand. Where does it go? I couldn't tell you where it goes. I know that those loans, and I know some people get a little nervous about them. It's a very low rate of interest there. You won't get lower, I don't think. I remember during the pandemic, we were borrowing, $1 billion at 1%. That's an incredibly low interest rate. So yeah, it's an important question. And, to try and understand what's going on in Joburg sometimes can prove impossible.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app
and DSTV channel 856.
The Green Economy feature on 702 in Cape Talk is brought to you by Volvo. Relax and test drive a Volvo plug-in hybrid today. Well, so often you'll hear about the importance of environmental authorization applications. How if a company wants to build a project or an installation, or you want to expand one, you have to go through the process of getting permission first. New reporting suggesting that virtually none of these applications are refused. I go back and forth a bit on whether this is a good or a bad thing. Tony Carney has been looking at this, an investigative journalist at Daily Maverick, among other things. Tony, good evening. So the whole idea of these applications, I suppose, is to make sure there's no long-term environmental damage when people build things. How often are these applications refused?
Hi, Stephen. I think EIAs are a precautionary tool to minimize or reduce negative or avoidable environmental impacts. They're not there to block development. Last year, for example, in the last financial year, there were close to 2,000 applications, EIA applications, and less than 4% were refused. In fact, in some provinces, in 3 provinces, no applications are refused. they are all approved. So it does sort of that EIAs have often seen as kind of a stumbling block or a hindrance to development. But if you consider the potentially serious impacts that can result from certain developments, precaution is called for. So these are sensible measures of public consultation designed to try and reduce the impacts.
Is this a provincial function or is it a national function?
It's concurrent, both between the national department and provincial departments. And curiously, the mining, minerals, petroleum department regulates mining applications, which is a bit of a fox and a hen house situation, but that's how it is.
Okay. So there are a couple of ways to look at these numbers. I mean, such a small refusal rate. The one is that the departments have just decided, and I can understand the argument for this. It may not lie well with everybody, but they've decided to kind of be enabling for economic reasons. Another way of looking at it would be to say the companies that are applying will have been very careful with their application. They'll have made sure they comply with the law. And as a result, we shouldn't be surprised if they actually get approved. The other way of looking at it is that the departments are not really paying them any attention, and unless there's a massive red light or a lot of public opposition or something, they're just stamping yes on all of them. How do you see it? I mean, is it possible to know?
Well, look, I think the EIAs are subject to an appeal process through the Department of Environmental Affairs, and they can also be reviewed in the High Court. So there has to be a measure of responsible scrutiny. It's not simply a rubber stamping process. But having said that, there is a very high rate of approvals, it could be the case that a development project is amended during the process, which is a good outcome if it makes the development less risky. But I think a stark example of the value of the EIA process is if you look at the UPL chemical disaster in Durban during the July riots. This was a chemical storage a storage area that was located very close to a residential area in Durban. It was satellite, and as a result, there were thousands of tons of toxic chemicals that spilled into a nearby river, into the sea. The beaches were closed for several months. The environment is contaminated, and you might say, well, would an environmental impact assessment have made any difference? I mean, it was burnt down. So, but that ignores the fact that if there'd been a proper assessment, would that location of a hazardous storage area been approved so close to a residential area? What measures would have been recommended as part of the process and the assessment? For example, to put a moat around it, to use sort of kind of crude terms, where you have an area where if you have a lightning strike or an arson attack, whatever, and chemicals spill, it's contained in an area. It doesn't spill out into the environment. And in the UPL case, they're facing charges of not conducting an environmental impact assessment.
Sure. Tony Carney, thank you. Really, really important story, that. The investigative journalist at Daily Maverick.
The Money Show, Africa Business Focus.
With Professor Rutendo Ndingwi, the founding director at Tribe Africa Advisory and author of Rumble in the Jungle Reloaded. How's it, Rutendo? A drone maker in Nigeria. Everyone's talking about drones at the moment, especially with the war in Russia and Ukraine. But this Nigerian drone maker, they've raised 52 million rand. They're going to build a big drone factory.
A big drone factory, Stephen, and there'll probably be a lot of drones sounds in the factory. But good evening to you, Stephen. and good evening to your listeners. So the company is called Terra Industries, and it was actually started by two young men who've applied for another $18 million of investment as a tech startup, and they've got it. So they're now on 52, and one is called Nathan Kwachaku, and the other one is called Maxwell Maduka. Both are based in Nigeria. One is 22 years old, 24 years old. So quite ambitious, quite young. If you recall, Steve, we talked about this story some months ago, and they had finalized building a 15,000 square foot factory in Nigeria. They've now gone to Ghana to finalize investment to start off another 32,000 square feet. And they're going to be based in London. So because they want to expand globally, they expect to be producing by 2028 50,000 units, Stephen. And the main driver of the investment and their drone focus, Stephen, is in the manufacturing and service, and also overseeing security facilities in high-risk areas, infrastructure. Obviously, it's going to be aligned to military one way or the other. They estimate they'll be covering assets to the value of $11 billion. So it's quite a significant offering and solution, and they seem to have already buyers in terms of their services, Stephen. So it'll be great to see how it grows out. I think the fascinating thing for me, Stephen, which always excites me, it's manufacturing that's happening in Africa, value add, and they're going global. They're targeting Asia, they're targeting the Middle East, and a number of other countries in Europe in terms of supplying solutions. So let's see how it goes, but otherwise a great story from Nigeria to Ghana to the rest of the world.
Yeah, I know. Interesting to see how it pans out. The Rovuma liquefied natural gas project, ExxonMobil putting a lot of money there in Mozambique.
Yeah, Stephen, with the ExxonMobil LNG gas, everybody's been wanting this project to take off. I mean, if you see the number of partners who are offering, whether it's manufacturing components or services, you've got people from, besides the Mozambique SOEs, Italy, Korea, Middle East, Europe, quite a number of players. But the investors of the $30 billion needed to start off the project, everybody has been a bit hesitant because they've kind of removed the force majeure, but at the end of they've raised the force majeure. But I think the big challenge was that there's still an element of risk. So they've committed to $1.1 billion, which is about 4% of the project investment, and hopefully by the end of the year they'll actually release the next amount so that the project can go full throttle. It's estimated, Stephen, once this project goes full throttle and everything is pumping literally, they expect to produce 18.6 million tons of LNG, and this is the Rovuma LNG plant per annum. And government revenue over 30 years, Stephen, is estimated to be $150 billion to Mozambique. So there's a lot of investment, a lot of ambition, but still there's an element of risk because of the civil unrest caused by the militants. I think it's more or less up north, Stephen. So hopefully it takes off. You can imagine the way this will stimulate the economy of Mozambique if it does. And a lot of people are keeping their eyes on this.
No, absolutely. And they'll be watching that insurgency in the north of the country, which seems to be a lot quieter as well.
Yeah.
That'll be a big factor.
It will be.
Diego, which is Diageo, the big
Diageo.
The big. What do they make? Oh yes, alcohol. Kenya's competition regulator, they want more reserve as a fund. I mean, I find this interesting. I mean, this is not a company that's lacking money. Anyone can see that.
Yeah, so it's Diageo. The challenge is not actually with Diageo, Stephen. It's actually, Diageo wants to make an acquisition of East African Breweries Limited, EABL, and what the competition regulator has proposed that EABL puts aside $115 million. And this is to cover potential liabilities and third-party claims. You understand EABL, Stephen, plays a big role in terms of that ecosystem of business. It's a great opportunity. On one side, you understand where the regulator is coming from, because obviously, if there's risk that is forecasted and it's not mitigated after the transaction, the consequences are quite dire, not just for the company, but for the economy, because it's such a big cog. But at the same time, the investors themselves are getting frustrated, especially Diageo, because these guys are saying we've gone through a number of hoops to get to this point. The deal, from our perspective, everything is aligned. It looks great. And this final frustration is a thorn in the flesh. So, again, unfortunately, one of those challenges that are always there when the regulator and the investor clash. But at the end of the day, it seems to be for good reasons. Just hopefully the deal finally comes through so everybody can go singing.
I mean, these deals always take quite a long time, and the results of them can often be really important. So it can be quite frustrating for everybody that they take forever.
No, they do. It's a challenge, Stephen. And I think we've seen even here in South Africa. I remember the Messmart deal with Walmart, Stephen. Remember how that went through a lot of regulatory loops. And obviously, in a unionized country, that's expected. But again, Stephen, you're 100% right. And I think from an investor perspective, it kind of sets a tone or a precedence in terms of, the perspective that Africa is high risk, that there's a lot of red tape, there's a lot of bureaucracy. Yes, it's understandable that you want to accommodate and protect the entities and the employees, but still, it's a frustrating process for the investors. So hopefully this is resolved sooner rather than later, Stephen.
Angola and Morocco, they're setting up, is this a joint chamber of commerce and industry?
A joint chamber of commerce industry, and it's actually an interesting story. It wasn't big, Stephen, but when I came across it, I found it fascinating for two reasons. Geographically, Morocco is on the tip of Africa, North Africa, bordering the Mediterranean. Angola is Southwest Africa, bordering the Atlantic Ocean, almost close to us. But when you look at those both economies, it's a win-win. Because if you think about it, Morocco has been tipped by the African Union to be the most industrialized country at the moment, and at the same time, Angola, previously dependent wholly on oil, is now diversifying its economy. So I think the merger of the two, a lot of industrialization skill in Morocco, leveraging off Angola that is quite keen to diversify, and it's got all these commodities. I think it's a great opportunity. So they actually see how that relationship, which is very unique, but I think this is what Africa needs. That's the kind of collaboration that will take the continent to the next level.
So, not everybody likes Morocco. We don't like Morocco, our government, because of Western Sahara. And for Morocco, Angola could be a little stepping stone in some ways.
Yeah, it could be, because that whole Western Sahara saga, obviously Algeria is also in there, and the guys at loggerheads does always complicate the politics. But I think just quoting, I think one of a senior executive in government one day who said, look, economics will always trump politics.
Yes.
And ultimately here, the politics will play a key factor with regards to the collaboration. I think it's more of the politics collaboration as opposed to the politics. And if that helps people get jobs, industrialize, develop the economy, all good and well.
In Kinshasa, 500 people have gathered for a skate festival. Is that a big ice rink? That's a joke.
500 young people, Stephen. The initiative is on its second year running. It's called the To Skate Festival. It's been started off by a young man called Eddie Malonga, a social entrepreneur. And basically, he wants to use and promote skating, not skating in terms of ice skating, but the skating with wheels as an urban sport. And it's a great, I think, necessary and productive distraction for the guys in the DRC. Obviously, we always hear about commodities, we always hear about the rebel wars, etc. But he's doing something that's absolutely phenomenal. He's getting young people to come together to skate, and he wants, and 500 of them meet in a rink that has been, I think it's almost like a basketball court, but it's arts, it's a street vibe, it's great participation, and he wants to promote this so that the guys get the opportunity to even go global. So it's a great initiative and touching on the entertainment aspect of Africa and the cultural aspects of Africa, which DRC has a lot of. And I think it's a great story, and look forward to hearing this grow and glow.
Indeed. Professor, thanks so much. Rutendo Windingwi, Founding Director of Tribe Africa Advisory and author of the book Rumble in the Jungle Reloaded. He'll be back with you again next week. You're with The Money Show, just gone 7:30.
The Money Show.
Personal Finance with Warren Ingram.
23 minutes now to 8 the time. Your questions for Warren Ingram this evening. He is, of course, a certified financial planner at Galileo Capital. 011-883-0702, 021-446-0567, and voice notes on 072-702-1702. We're talking tonight about how, when you get to the age at which you retire, you can continue to draw an income without actually running out of money. In a way, this is the whole point of personal finance, is to be able to live, and I do mean live, not just survive, and make sure that you're able to actually have enough money. You don't draw the money down. So, Warren, good evening. you retire, you stop getting paid for working, you have savings, and you've got to make that into a monthly income, and it's got to last a long time. How do you sort of start the conversation around this?
It's a strange sort of psychological dynamic for people who go into that position, because the first question they ask is, just tell me practically, like, how will the money go from my savings or my investments into my bank account so I can spend it? And it's kind of a journey that we all go on at some point, where, you know, we've always had incomings from work, however we've worked and however we've generated the income. And we could manage our outgoings that way. But now you get to a point one day where you don't have an incoming, and you've only got these outgoings. And for a lot of people, it's very, if not scary, just sort of a puzzle, like a psychological puzzle. And I think maybe the starting point is just to understand how much you can take from your savings, your investments, and still be safe. And, you know, a lot of us will be quite worried about that. You know, we'll get to the age, let's say at 65, and we say, okay, I want to know that I can live a sustainable life, and I've got to find that balance of, you know, not living so cheaply and so frugally that actually, you know, my retirement is really bad and really uncomfortable. And equally, you know, I can't go and live like a king for 10 or 15 years and then have nothing and be dependent on my family or the state. So the starting point, Stephen, would be, you know, look at the value of your investments, and then use the magical number of 5%. So you take your calculator and you say, if my retirement savings, I'm going to use an example. So my retirement savings are 6 million rand. What's 5% of 6 million? Because that's what I can draw on an annual basis to be sustainable. And so 5% is going to be 300,000 rand a year. If you draw that and you invest your money just kind of sensibly in a very balanced way, you know, nothing spectacular in terms of chasing, you know, the latest SpaceX, whatever that's going to be the next one, not worrying about Nvidia, but just a balanced portfolio of cash, bonds, property, shares, you know, in South Africa and overseas. The likelihood is that 5% will be sustainable for your lifetime. 30 or 40 years, you'll be able to live a quality life. But if you start at 10%, so on 6 million, you draw 600,000 a year. You just need to realize on day one that you're probably going to run out of money in somewhere around 12 to 17 years. My view is around about 15 years. And I think that's maybe the point where a lot of people go wrong, is right at the beginning. They either draw far too little because they're so desperately worried about running out of money, or they draw far too much because they go, this is what I need. You know, I can't live on less than whatever the number is. But if you start that way, there's no way to recover. So if you're drawing far too much on day one, it's impossible for an investment to grow at 10 or 12% a year for 40 years. There is nothing that does that. You could be lucky and get that. But if you start at 10%, you have to make up all of that plus inflation, and you're just not going to come right. So I think that starting point is the magical number of 5%.
And that's a year, so you need to divide that by 12 to work out what you're going to be living on every month, basically. To put it another way, what your new salary is.
Yeah. And so you look at that and you say, well, that 300,000 a year, that's going to be around about 25,000 a month before tax. And the one difference between our normal salary from work and our income from our investments is we have a little bit of capacity to do some, you know, good and certainly legal tax planning, because you can allow some of that money to be capital growth. So when we pay tax on our savings and our investments, generally we're going to either pay tax on the interest, or if we've got rental income, we're going to pay income tax on those two, or we're going to pay capital gains tax. And for a lot of people, when you've got an investment asset, an investment portfolio, you might find that actually you end up paying a bit more capital gains tax. So your 25,000 a month, you're not paying away 45% of that to SARS. You're going to pay away a lot less. So tax planning becomes a bit better, and equally that the tax boffins will also tell us in the messages that when you turn 65, you start to get a lot more tax benefits from SARS as you get older. You get a few more tax breaks, and those improve at 70 and 75 as well. So I think that 5% number is really key in this whole thing.
Okay, so do you stay at 5% the rest of your life, or do you? And I just want to get this right in my head. So your money is still growing, right? So the 5% is basically to keep up with. It keeps up with inflation and your investment. So the money that you have, let me put this another way. You retire. You have, the example you used was 6 million rand. The 6 million rand is still growing because it's still invested. It's not sitting in your bank account. It's still growing because it's invested, right?
Exactly right. And I should explain how and why that 5% works. So you take your 6 million, you invest it in a good balanced portfolio. It's likely that over a decade or 3 or 4, so let's say 40 years, realistically, if we retire at 65, most of us won't make it to 105, but we wouldn't mind planning that just so we're safe. We run out of life before we run out of money. And so in that instance, you would expect a balanced portfolio to give you round about 10 or 11% growth a year. And if that's happening and you're drawing 5% a year, it means you're leaving behind 5 or 6% a year growth to compensate for the cost of living. Our big concern here is that you want to make sure that the buying power of your money is consistent over time. So if you're drawing 5 and the cost of living is going up by 5, then your growth rate of 10% is exactly right. And so certainly at the early stages of retirement in the first decade or two, I think you would do well to keep drawing 5%. And understanding that, when you start at 6 million, but your capital is growing, it doesn't mean that you're only ever drawing 300,000 rand a year. Next year, you'll be drawing a higher amount because your capital has grown. And so in most of the years when we get good growth, you might actually be able to draw a slightly higher rand amount because the percentage goes up. But, and to your question, there will be times when, unfortunately, the markets go down, your investments go down a bit, and your 5% might be a little bit less than it was the year before. That's the downside of living on your investments. But when you get to age 80, 85, by all means, you can start to increase the percentage that you draw. You can start to go up to 6, 7, or even 8% as you get older. And I mean, the maths is simple, but the reality is then that you're not really planning to live for another 40 years if you're 85. And so it means that you can start to draw a bit more, because the likelihood is that if you're eating, into your capital a little bit as you get older, you're not going to run out of money before you pass away.
You also suggest that you should keep a cash buffer. Now, what's the cash buffer for?
So this is, we've spoken on the show a lot about emergency funds, and this is a little bit different to an emergency fund. So for a lot of people, if someone was retiring, right now, and they were retiring on the 1st of September, they might be rather worried when they look at the state of global markets that, things have been going pretty well all around the world, and there's an enormous amount of fear, but stock markets have done fairly well. And there's I guess a rational concern that maybe markets might fall over and drop, 20 or 30% somewhere along the line in the next year or two. And if it's your first year of retirement and your investments, you're starting with 6 million, and suddenly, the markets lose 20%, that has a really big impact on the rest of your retirement. So the propeller heads call this sequence of risk returns, but let's not get stuck in the jargon. What it really means is, if you're drawing from your investments, at the start and the very first few months that you're drawing, the markets are going down, it has quite a big impact on your financial future. And so the way you can protect yourself against that is to start with quite a nice big cash buffer inside your portfolio of investments. And for me, you could look at around 6 to 12 months worth of your expenses. And it's not, you're not investing in something amazing that's going to give you a great return. You're going to choose something like a money market fund. And when you start your retirement career and you start drawing from your investments, if the markets are going well, the portfolio is doing okay, then you leave your cash buffer alone and you keep drawing your 5% from your investment portfolio. However, if you start on the 1st of September, to go back to the example, and early November, the markets fall over and global markets lose 40%, then you don't need to keep drawing from your investments. You can go to your cash buffer and start to draw some or potentially even all of your income. If you've got 12 months worth of expenses, you can start to draw an income from that buffer for, let's say, 6 months. And if you draw from that for 6 months, the likelihood is that the worst of the market crash will be done somewhere around that 6-month period. And you can start to rebalance the way that you draw. So that cash buffer is really powerful for people who are worried about the big market moves. And if things go well when you start your retirement and the markets go up for the first decade and nothing goes wrong, keeping that cash buffer is a very nice psychological kind of safety net. And then if the markets take a hiding, you've always got that powder dry to deploy when you need it.
Okay, I've got some other questions to ask about this. It's very interesting. We do have a question though, saying, "Hi, I'm 36. I run my own small business. I don't have any benefits through an employer. I'm the only income earner in the house, and I have 2 young children." So you can imagine what this person is thinking and about what they're actually thinking about and how they're looking at trying to manage it. But then they go on to say, "I have life cover in case I die, but a friend mentioned I should also have something called income protection or disability cover. I don't really understand the difference, and money is tight. So I'm not sure, is it worth it?" It's from Sifiso. Do you need income protection or disability cover, and what's the best way to do it? Sifiso, Warren will have an answer for you in just a moment. 10 minutes now to 8.
The Money Show with Stephen Grootes is brought to you by Absa Group and DHL Go Trade. African SMEs are now closer to global markets.
The Money Show.
Personal Finance with Warren Ingram.
9 minutes to 8, Warren. We have questions from Kanisa in Randfontein and Gary in Brooklyn. But first, Sifiso's question. Do I actually need income protection or disability cover? I do have children. I do have life cover, but money is tight. How do you look at Sifiso's question, Warren? Because, I think income protection is really important, but it's not cheap.
It's not cheap, and ticking the first box of having life cover is a very good call, and why a lot of people are happy to do that is because if you're young and healthy, then life cover is relatively cheap. But unfortunately, disability cover is usually quite a bit more expensive, and especially for someone in Sifiso's position where they're on their own in their own company, and so I think the short answer is I understand money's tight, so that's the tricky part. But is it worth it? Yes, it is. The thing about being 36 years old is your company might be an asset for you, but your other biggest asset is the next 20 to 30 years of your working life where you have an ability to generate an income. So ensuring your first or second biggest asset makes a huge amount of financial sense. And so I would say, yes, you should do that. And get a few quotes to find out, what it would cost. The difference between disability and income protection. Income protection will pay you a monthly amount, hopefully going up with inflation for the rest of your working life. If you are disabled, let's say it happens at age 40, then to the age of 65, you would get a kind of the equivalent of a salary. Whereas disability is usually a lump sum, and they'll pay out a lump sum to you, and then you decide how that money is deployed to look after yourself. And they can be expensive, but I think it's a huge risk that you should be insuring against to protect yourself. You are the only breadwinner, and it's your own business. It's worth doing.
Okay. Yeah, I know. Very wise. Sifiso, you're going to have to consider that. Kanisa and Randfontein has a question. So, Kanisa asks, Stephen, please ask Warren, when did it change from the 4% rule to 5%? Was it the 4% rule that you could spend 5% a year?
The 4% rule's magic, and the reason that they're different is 4% generally applies more to people who live overseas. It's kind of a US rule. And in South Africa, we've tended to have slightly higher returns above inflation. So retirees here can start with a slightly higher drawdown. But in an ideal world, if you are able to start at 4% at age 65, I think it's a good call. You do get that safety. But if you start at 5% at age 65, you should still be okay.
Okay, and then Gary, I don't know if you can help Gary here. Warren, I'm a pensioner. I'm 65 years old. I've bought a lot of SPAR shares, and SPAR's had such a rough time. And they've already lost 30%. I'm starting to panic, and I'm having too many whiskies. What should I do? Sell or hold on? I mean, this is really a question about SPAR, but it's a reminder, Gary, of it's a reminder, Warren, of what happens if you put too many eggs in one basket.
I've got a few strong pointers for Gary. Number one, stop the whiskies and save your money. It'll help you be clear thinking when these things come around. Number two, once you're in a specific share and it's going down like it has, it will pay you to understand the future prospects of a share like that. So it doesn't really matter what you paid and what it's worth today, because the deal is what's going to happen into the future. So if you do your homework and you realize that SPAR's not going to recover, if you believe that the other competitors in South Africa are doing a better job, better management teams, more realistic chance of growing, then your situation is that you probably need to sell SPAR and deploy the money elsewhere. However, if you think that you understand why the share's gone down and you think there's a turnaround and you think that it will do better than its peers, then you should hold on. Which of those two is true, I have no idea. I think it's a bit of a coin toss if you were to ask me. And then maybe the other comment is, if you are going to sell, take the money and spread it across a proper spread of shares. Don't allocate a large chunk of money to one share. You're going to end up in this story again and again, unfortunately.
Okay, we've got just 2 minutes left. You mustn't put everything into cash, right? It might be tempting, but it's a bad idea.
Yeah, so we're living, in, as I was saying at the start, really volatile times now. And, the temptation to say, well, let me just earn an interest rate while everything settles down. It's such a psychologically attractive idea. The problem is that, things might not settle down for 4 or 5 years, and markets could boom in that time, even though everything is rocky and scary. And your biggest enemy when you start your retirement career is not volatility of markets. It's the cost of living that goes up every single day of every single week of every single month of every single year. And you have to protect against that. And unfortunately, putting all your money in cash only guarantees that you will not be able to do that. So the certainty of cash is so expensive that you're going to have to embrace the idea of spreading your assets across the stock markets, the bond markets, property markets, and then some cash.
And then the idea of a living annuity. So how do you do that? I mean, how do you match the product to the person?
So most of us, when we retire and we take our, retirement funds, whether they're company retirement funds or retirement annuities, we legally retire those. So we retire ourselves and we retire our retirement funds, and we can put the money into a living annuity, which means we own the asset, and we decide the amount that we want to withdraw. The law allows you to withdraw somewhere between 2.5% to a maximum of 17.5% from your living annuities when you retire. We've just discussed that you really shouldn't do 17.5%. That's a really bad idea if you're starting out your retirement. And equally, that you might want to stick to that somewhere around that 4, 5, 6%, don't go over. If you're really desperately worried about markets and you think that, the world's going to kind of end again and again and again, and you don't have the emotional fortitude to deal with markets going up and down, which is going to affect you in a living annuity, then you could exchange your retirement lump sum for something called a life annuity or guaranteed annuity. And that's when you basically give all your retirement funds to an insurance company, and in exchange, they give you a guaranteed income for life. Hopefully, they allow that income to escalate with the cost of living. The big trade-off there is nothing left. When you die, the money's gone. But in your living annuity, when you die, the money that's left over goes to your beneficiaries.
Warren Ingram, thank you very much indeed, the co-founder of Galileo Capital and Personal Finance tonight.
The Money Show with Stephen Grootes is brought to you by Absa Group and DHL Go Trade. African SMEs are now closer to global markets.
Well, in the US, the Dow Jones is down. All markets are down. Obviously worried about bond yields, which is all about oil prices. The Dow Jones down 0.17%. The Nasdaq down 1.2%. And the S&P 500 down 0.57% so far. I fear there might be a bit more pain to come. Let's see how it all goes tomorrow. And that's when we'll tell you how it all goes. Good evening. It's 8 o'clock.